While some may find the information presented in this video surprising, I think it is crucial to address it before the situation worsens. The banking landscape is rapidly evolving, and this will have significant repercussions on everyone's lives in the coming months. Please make sure to subscribe to the channel and leave us a like below the video. In 2023, we are already witnessing the onset of a credit crisis that threatens to undermine the quality of life for many American families. Loan conditions are tightening while the cost of living continues to rise. Access to credit is poised to become a substantial concern for U.S. consumers, and experts are drawing parallels to the financial crisis of 15 years ago. The recession of 2008, which resulted in millions losing their jobs and their savings, also triggered the most severe credit crunch in history at that time. Many individuals faced insolvency and foreclosure as they struggled to meet their loan obligations and provide for their families. Between 2013 and 2019, consumer debt stabilized as the economy recovered. However, the pandemic disrupted economic stability, causing Americans to rely more heavily on their credit cards to make ends meet. Today, we carry a heavier debt burden than ever before, and the risk of a widespread banking system failure looms large. Financial institutions are becoming increasingly cautious about whom they lend money to. Bank loans enable us to purchase homes, cars, send our children to college, and make purchases on credit. The capitalist model has thrived on the extension of credit and the resulting debt it generates. For decades, the U.S. consumer culture has encouraged buying first and paying later, helping households manage immediate expenses but simultaneously contributing to record levels of debt year after year. Now, a combination of persistent inflation and rising interest rates is stretching consumers' budgets further. Data shows that most households are nearing a breaking point. Last month marked an unfortunate milestone as credit card debt in the U.S. exceeded $1 trillion for the first time, according to the Federal Reserve Bank of New York. In the second quarter alone, credit card balances surged by $45 billion, reaching $1.03 trillion, more than triple the average amount of new debt households took on in the same period since the Great Recession. The Federal Reserve's latest report on household debt and credit reveals that not only credit card debt, but also auto loans and mortgages have driven overall household debt to $17.06 trillion, nearly 15% higher than pre-pandemic levels. This translates to an additional $1 trillion of debt each year for 3 consecutive years. This increase is due to the cost of living rising 4 times faster than income since 2020. For the past 2.5 years, households earning median income or less, representing approximately half of the population, have had no choice but to rely on credit to cover their monthly expenses. From July 2022 to July 2023, total credit card debt increased by 8% for 5 consecutive quarters, reaching some of the highest growth rates in 2 decades, according to Wallethub. Unfortunately, experts predict that this trend will continue to rise. Matt Schultz, chief credit analyst for LendingTree, attributes this to factors such as inflation, high interest rates, and the overall high cost of living in 2023. According to Mark Whitner, chief economist at Piedmont Crescent Capital and a former senior economist with Wells Fargo Securities, higher interest rates are further complicating the economic outlook. The Federal Reserve's aggressive tightening cycle has raised interest rates to levels not seen in over 2 decades, affecting mortgages and credit card interest rates for everyday consumers, as Sophia Pig, an economist at the decision intelligence company Morning Consult, explained during an interview with CNN. As interest rates rise, the cost of servicing debt becomes more burdensome, especially as consumers continue to accumulate more debt. This combination places significant strain on households already operating with tight budgets. Essentially, the policies of the Federal Reserve are enabling credit card companies to charge exorbitant interest rates, making it even more challenging to pay off outstanding balances. Currently, credit card interest rates have soared to an astonishing 20.6%, the highest since data tracking began in 1994. Greg McBride, an analyst at Bankrate.com, emphasizes that people aren't willingly financing purchases at such high rates. They are doing so out of financial necessity. Many individuals are facing tight budgets, and if rates continue to rise, the consequences are uncertain. This is particularly concerning as 55% of cardholders carry a balance from month to month with double-digit interest rates. Credit may no longer be a means of financial stability, but rather a pathway into deeper debt. A survey by Redfield and Wilton Strategies revealed that 74% of Americans are worried about their ability to pay off credit card debt this year. On the flip side, some individuals are exploring alternative methods to escape debt, such as tapping into their 400 and ONIC accounts due to financial distress. Bank of America reported a 36% increase in the number of people making hardship withdrawals during the second quarter compared to the first 3 months of the year. Almost 2/3 of consumers are already concerned about access to credit in light of rising interest rates and stricter lending standards at banks. According to the New York Federal Reserve's survey of consumer expectations, more than 60% of respondents indicated that getting loans, credit cards, and mortgages has become more difficult compared to a year ago, marking the highest level in a data series dating back to June 2013. Concerns about credit access have been steadily rising, particularly among low-income Americans and small businesses. Another alarming trend for banks is the significant increase in debt delinquency in recent months. The number of individuals delaying debt repayments has more than doubled since 2019. Delinquency rates have surged, reaching levels last seen before the 2008 housing bubble burst. The rising number of delinquent accounts underscores that borrowers are already struggling to keep up with credit card payments. Government data reveals that transition rates into early delinquency for credit cards, auto loans, and home mortgages increased during the second quarter. Mortgage delinquency rates are approaching levels not seen since before the 2008 housing crisis. Similarly, moving averages for auto and credit card delinquencies are at their highest levels since the first quarter of 2018 and the first quarter of 2012, respectively. However, getting out of debt and maintaining a good credit score has become more critical than ever. Banks and financial institutions are tightening lending standards, rejecting applicants, raising minimum credit score requirements, charging higher interest rates, and lowering credit limits. Earlier this year, following the collapse of several major banks, financial analysts raised concerns about a potential credit crunch, a term used to describe an economic situation when consumers and businesses struggle to access the loans they need. According to data from the U.S. Central Bank, by the end of June, the rejection rate for all types of loans, including credit cards, mortgages, and auto loans, had surged to nearly 22%, the highest point in 5 years and one of the highest readings since the survey began in 2013. Due to inflation, significant interest rate hikes, and issues within the banking system, the financial industry finds itself with less capital to lend, as highlighted by Randall Watsek, a financial advisor at Raymond James. When resources are limited, the focus shifts to lending to the most creditworthy individuals. Banks are now requesting more extensive financial documentation than usual, especially concerning income verification. This poses a particular challenge for gig workers and small business owners, as their income often stems from self-employment. It's a paradoxical situation where those in dire need of funds often struggle to secure loans, while banks are eager to lend to individuals with pristine credit histories. Credit scoring firm FICO categorizes credit scores as follows. A score between 670 and 739 is considered good. 740 to 799 is excellent, and above 800 is exceptional. In essence, lenders are less inclined to engage with individuals whose scores fall below 670, a group representing approximately 35% of the population. Recently, major credit card issuers like Visa and MasterCard announced impending fee increases in October. This marks a period where credit has seldom been costlier since the start of the century. Therefore, if possible, it's advisable to reduce debt and refrain from using credit cards during the current economic downturn to avoid falling into a debt spiral later. The ongoing credit crunch will exert financial pressure on many borrowers with substantial debt burdens. If you find yourself in this situation, seeking professional assistance to regain your financial health is crucial. Unfortunately, financial education is lacking in our society, leading many people to financial trouble due to a lack of understanding about the consequences of accumulating debt. Once in financial trouble, it can take years to recover, impacting various aspects of one's life. Now is the time to take precautions and prepare for potentially challenging years ahead. The banking sector faces risks, and the financial system is undergoing significant turbulence. It's important to note that the Federal Reserve may not intervene to bail out as it has in the past. The potential for disaster is real, and delaying action only exacerbates the problem.